Welcome to Fintech Daydreaming, the podcast that dives into the world of banking technologies and the ever-changing landscape of fintech companies. We bring you real-life examples from global and local thought leaders, as well as experts working within the financial industry, and seek out the best stories from the front lines of financial services innovation, where dreams of industry pioneers meet reality. Hosted by Paul Krogdahl and Ville Sontu. This is Fintech Daydreaming.
Hello and welcome to Fintech Daydreaming. It's another episode of all fintech goodness coming your way after 2 weeks of break, and we are already heading into the Christmas season. And I'm actually recording this in the Copenhagen office here in Denmark, and seems like things are rolling really fast and almost getting back to normal. I really hope that the situations don't get any worse right now, because everything seems to be moving forward really quickly now. So again, without any further introductions, I welcome back my co-host, Paul Krogdahl, who is always here as my wingman. So how are you, Paul, today?
I'm good, Ville, thank you. Yes. Again, you're traveling. I think the last time we recorded an episode, you were also traveling. So things must be getting back to normal with all the traveling that you're doing. I'm still stuck here at home, not done a lot of traveling at all. But I know our guest has been doing some traveling as well, as he's been traveling around the world doing promotions of his new fantastic book, which if any of our listeners have not bought and read, I'm going to be extremely disappointed.
Indeed. So we are very happy to welcome back to the podcast, his second time on the podcast, and we're lucky to have him back here because he has a new book out. So again, welcome, Paolo. How are you today?
I'm fine, thanks. And not traveling as much as I used to pre-pandemic, by doing well and also promoting this new piece of work. I'm grateful that so many have already ordered, read, and reviewed this thought leadership piece. So thanks to everybody.
Great. So for the few people who might have missed the episode we did with you last year, or might not know you, so could you give a bit of an introduction? Who are you, and why are you here today?
Also, well, basically, I'm a former risk manager in banking. I'm a former startup entrepreneur, and I work for IBM now. I'm formerly the global research leader in banking and financial markets for IBM Consulting, the Institute for Business Value. My role is basically to understand the industry and the business models, see how technology can make them work, and keep everything inside the regulatory framework, which is very important for the industry and to protect the investor. And I'm also a book author. I just released my 5th book, Banks and Fintech on Platform Economies, Contextual and Conscious Banking, which discusses which is the real competition, which is happening, going on, which is the industry going forward on platform economies.
Great, and we're going to get to all of that goodness very soon as we dive into the topics and themes you write about in the book. But before we do that, we of course have introduced one new element into the podcast since you were here last time, Paolo, and that is that instead of us telling a very, very bad fintech joke, we politely ask our guests to provide either a good or a bad fintech joke if they have one to share. So, Paolo, I mean, it's a bit of out of the blue, but do you have a joke for our listeners?
Okay, so I have a provocative joke or statement, which I believe is a good introduction to the podcast today.
Okay.
If money doesn't grow on trees, why do banks have branches? Now, actually, you know that Bill Gates once said that people don't need banks, they need banking. Very much so. However, they must still need bankers. The fact is that those bankers will have to work in a very different way compared to the past to stay relevant, and they can stay relevant, which is the core of banks and fintech of platform economies that basically draft a balance between the full digital and the full analog in a way that everybody can position and generate value for the clients and the stakeholders at large.
Actually, I've got a question on that straight off the bat, because in a very recent episode, I asked exactly the same question, Ville, and I think I provocatively sort of threw it at you because you work in a bank. But I'm wondering, Paolo, based on what you just said, this whole changing from analog to digital and the changing needs for bankers and the roles that they perform, do you believe that there is a fundamental need for the executive level at banks to fundamentally change, to be able to understand not the old world of banking, but the new world of digital?
Well, I think it's very important. It all starts at the top of the institution. And the reason is because it is not about lagging technology to do the same things that banks were doing before, just on digital or more efficient. That's not the case. The issue is how to adjust the business model to the digitalization of financial services. So it requires a different business proposition. And that's why the board in particular needs to be more literate in terms of technology. That's why technology needs to understand that the business and the real nature of the banking clients without being confused by what they hear or read or see in the e-commerce world, because banking is a special industry. And that's the reason why the role of regulators is super important, because as business models change, the role of banks change inside the economy and society, and regulator needs to be on board and have a clear picture about what is going on. And essentially, this is one of my humble contributions, try to basically bring all of these actors together with a new way of connecting the dots so that they can see how things are changing and they can position for the best.
Yeah, I think heading straight to the deep end, because you mentioned regulation. Of course, one of our favorite recurring themes here on the Fintech Daydreaming podcast. And how do you see the regulators playing in the new digital economy? We're now seeing a lot of regulatory initiatives coming from the European Union, for example, to the financial sector and broader data economy in general, digital identity and all of these things being kind of regulated initiatives coming from the European Union. Do you see this regulating things into existence as a good approach, or would something else, like basically creating something outside of the regulatory scope, to be maybe a faster way to create new services? How do you see this interplay between these two things?
Well, when I published my second book of 5, the Fintech Innovation in 2017, the first one tweeting about that was the founder of a European robo-advisor. And I remember he tweeted, "This Paolo Sironi is strange. He says that the regulation is an engine for innovation." And I believe so. Regulation can be an engine for innovation. It at least started the motion of the open banking process. Clearly, in Asia, in China, they started without regulation, more for competition. But regulation is an important element, especially when things change a lot. The issue, however, is that regulators don't typically have the mandate to dictate what is the new business model for the industry, but somehow they have the levers to make sure that they understand that all the pieces get together and move forward. I was once invited by a regulator of a very interesting country, just not mentioning where they come from, but they're very interesting because they have under the same umbrella the prudential regulations, so the capital adequacy, the market regulations, so investor protection, and the insurance regulation. And you see, if we discuss the platform economies and the change for banking, why this is relevant. Now, they called me up saying, "We launched the sandbox, but we're not really sure what we have to do with that." So they wanted the conversation. I said, "Look, the sandbox is as good for you as it is for the fintech, because you need to understand that the regulations are also product-centric, like the industry, but the shift to customer centricity requires a change in the industry posture and in the way regulators see basically the world. Because the underlying element of a bond, a life insurance contract, or a loan is basically the same, it's financial uncertainty. And no client can basically fulfill his own goals by buying one product only in isolation from the others. So it's important to facilitate that mixture so that you can see everything in aggregate. So regulators as well have this chance nowadays to test new ideas on how the value can be generated in different ways inside the platform economies to help also the capitalism shifting from the shareholder value to the stakeholder value, which has different dimensions and different perspectives. Regulators are starting doing that. You can think about the ESG regulation, for example, the fact that are trying to infuse inside regulation perspectives which go beyond the short term, beyond the financial element, especially in Europe, where they accept the double materiality. That means the impact on financial perspectives as well as the impact on the problem that we try to solve, like the climate risk or something like that. So I do believe that regulation is an important element. Now, regulation is not perfect, like banks are not perfect, like fintech are not perfect, but if we all work together, we can reach a better shore. And last but not least, and this is my contribution, I think that we are at the moment of a seismic change. Is a very big change on the nature and essence of business and relationship with clients. It's like we're shifting from building energy using a carbon plant when you burn carbon, instead of building energy with a nuclear plant. Now, you cannot build a nuclear plant with an old theory. So you also need a new theory if you want to do that. So my interest and my role here is basically to touch upon all of the foundational elements which are necessary to make sure that as we build a new industry, we make that right with the right theoretical foundation so that the business model practically works.
Great. And I have to drop one anecdote here because I just read this from the news. It's related to regulation. It's almost like ironic that there's a casino that's going to be built now in New York, and they are planning to have a crypto trading desk inside the casino. Now, aside of the fact that it's the right place maybe for crypto trading desk to be in first place, but the fun part here is that the casino is worried that the casino regulation will not allow them to actually have crypto trading desk because it's too risky. And then we're having these discussions about whether banks could be in crypto as well. But again, it's a fascinating.
Actually, it's interesting because the subtitle of my second book, Fintech Innovation, was from robo-advisors to goal-based investing and gamification. So I was invited in the past to speak at quite a few gaming events because they said that banking is a regulated industry. We're a regulated industry. So it's very interesting to understand what happens in fintech, because we might also have to change it. If you think about today's the metaverse and the gaming perspective, they were very prescient and is rightly so. So interesting to see how both teams evolve. But anyway, what matters is to protect the weakest link, so the customer, because that's how society basically has to work to be inclusive. So change is good, but make sure that everybody is protected in the right way.
Great. Now, shifting gears, and we've been teasing this along this conversation already a couple of times. In your book, one of the big themes, of course, is platformification of banks. And it's a very trendy word that gets mentioned a lot these days. Even in this podcast, we've been talking about it several times. But, I mean, could you explain a little bit, how do you define platformification and how the platform theory in general was born?
Well, let's say that it's a tsunami for business culture, first of all. And the reason is because traditional businesses tend to be based on linear relationships between the manufacturers, the assemblers, and the distributors. Instead, on platform economies, relationship change, engagement is the key element, which to be sustainable needs to be based on hyper-personalization and hyper-contextualization of what is happening in the life, in the experience of the final consumer. So that shift corresponds to a world where businesses operate and excel in output economies. That means that they look at products. Products are central. The remuneration comes from margins on products, into a world that is based on outcomes. So the shift from output economies to outcome economies. Outcomes are typically asset light. It doesn't mean that assets are not important. You can think about Amazon. Amazon makes money on cloud, but they need to operate a huge marketplace to make that happen. So assets are there, but the final value that justifies business existence, so the margin, might come somewhere else, from the resolution of people outcomes, and those outcomes can be very different in different businesses and in different industries. And this is what is most complex for banks, because they're all constructed through the regulation also around the product definition and the product regulation, while in reality they need to position client centricity around the outcome of clients. But there's ways for doing that, and it is happening a bit at a time.
Do you maybe have some good examples that would help people to understand this transition from a outcome to an output to an outcome-based approach?
Yeah, so we can make an example, and I think this is also a relevant example to understand the problem of the banking industry. And to do that, I can use automotive versus banking. Okay, we stretch a bit the concept, but now, if you think about the way an automotive company works in a more traditional environment of the output economy, a car maker like BMW might work with manufacturers that basically built the best-in-class Navi system, an Italian artisan for the best leather for the back seat, or the Tiptronic on the steering wheel. Then they assemble all of these and they give it to a car dealer that sells to the client in the end. Now, what happens, and that's also very important, is that the final client, according to their level of wealth, can hyper-personalize their purchase because they can choose the color, all of these elements inside a car that they want to have. But you don't pay all of the manufacturers. You just pay the car dealer, right? So your engagement is with a car dealer, is an all-in price. Then you might engage with leasing or different ways of payment, right, for the purchase. But in essence, you get this product, is an all-in price, and then you can go from A to B, right, in your driving journey. Now, when BMW wants to operate in the outcome economy instead, they make something else. So they partner with Mercedes to build ShareNow, so a car sharing company. And basically, the scope is not to sell a certain amount of cars next year. The scope is to mobilize, 1 million citizens of Berlin to commute, going to the office in the post-pandemic world, right? When hopefully the economies open up again. Now, you understand that if that outcome is basically to help people go somewhere with a car that is not their own, but they feel like having it because they drive it, the experience is all it takes. And that's very important to have a good experience, because if you buy a car and then you don't like it, you cannot just resell it. Maybe some people can, indulge into this, but most of the people need to keep the car for a few years. But if you have a bad experience with car sharing and there's an alternative, you just switch to a different app and a different car sharing system. So the experience is absolutely foundational. And you see what happens with banking, because it's very similar now. Banks typically operate like linear economies, so output economies. So that means that there are manufacturers, which are capital markets institutions that help corporates to issue bonds and equity. There are asset managers that basically start pre-assembling some of these products into investment funds. Then you have the brokers or the wealth managers that do the final assembling in order to distribute to the client the investment opportunities, just to give an example. And at every step, there is a new cost, therefore there is a new price, that the price goes up in front of the client, or that the client has to pay, and that's a linear transformation of cost into basically pricing of the solution. However, when banks operate in platform economies, they need to understand that this is not anymore the game. The game is to change, like when automotive companies operate in the outcome economies. So in essence, instead of asking themselves how many millions or billions of these assets under management we want to sell next year, they need to ask themselves, how can I have my clients, being families, businesses, or individuals, fulfill their personal, their business, or their financial goals. And is the engagement to fulfill the goal, which basically justifies in the outcome economy the experience, and therefore the pricing and the monetization. Now, which is the key element and difficulty? The key element and difficulty is that if you think about the example I just gave between automotive and banking, still, even in the linear economy, automotive are already applying an all-in price to the hyper-personalization in front of the client. However, what happens in banking is that everybody of us, we cannot fulfill our goals in life by buying one single banking product. We need more banking products throughout our life. So we need a saving account, we need a payment method, can be a credit card or something else. We need a loan or a mortgage, we need to invest our money, we need a retirement solution, we may need life insurance or a different insurance product. Now, what happens is that the industry sells these products through different business units, sometimes different brands with different incentives, creating different data repositories that contain the same information about that client, which is always the same client, maybe some new information, different information about the products. And the client engages with these business units as if they get into a different relationship. There's sometimes a different KYC, I know your customer process, and so on and so forth. So at the end, they cannot be an all-in pricing. So what is really happening here is that in order to facilitate the shift to the outcome economy, banks need to understand how that relationship is becoming less linked to the individual product, which in any case is losing remuneration capabilities because low interest rates don't make loans and mortgages after the price for risk capable of paying back the value to the shareholders, because Vanguard entered the UK. Soon for Europe, we see there is a competition that lowers the embedded fees and commissions inside the bonds and the investment funds, because we see the competition in the payment system. So we know that maybe Square in the US can still price up 100 basis points for a payment solution, but Ant Financial does the same for 3, 4, 5 basis points. So that is basically the future. So as products in any case lose the capability to remunerate the business model, the possibility to get the client to pay an all-in price for all of this is the way of moving out of the current financial performance conundrum. There are two ways for doing that. One is basically to contextualize banking inside a different ecosystem. So the value is not in the product and the solution, but is in the removal of the friction that allows to generate a different value on the ecosystem platform. Or the bank transforms into a conscious banking activity where the client is conscious about the relationship, is the shift towards wealth management and financial planning, which banks have to undertake anyway, where the pricing is done on top for the whole planning exercise, not anymore, or in particular in percentage, not anymore on the individual products. Even the head of the Planning Association in the US last week said that 10 years from now, the pricing will be on the relationship, not on the products anymore. So in some markets, you see that more clearly, and in other markets, they're just a bit behind because of regulation, because of the level of competition. But in both cases, the contextual banking, the conscious banking, clients will have to be asked to pay for accessing the platform, the contextualized platform or the conscious platform. So the principle is basically the same on the outcome economy. It's just that the realization will be different according to the scope, the capabilities, and the strategic perspective of each institution.
Yeah, we're really fast shooting down all of these fears that banks usually have about when they get mentioned that banks should become platforms, they should have platform thinking. One of the main arguments that banks say is that we will lose the customer connection. If we're just a platform, we will not have any, we will lose the customer ownership of the customer, and all of these questions. Now, to me, it sounds like it's exactly the opposite. The customer centricity becomes the core of the whole platform proposition for banks as well. Am I correct in assuming that?
Yes, it's just that the way they do it may be different from the way a typical e-commerce company or big tech company does. Now, the core of the banks and fintech on platform economies, contextual and conscious banking, so this new book, is the banking reinvention quadrant. They want to explain banks how they can also engage into the outcome economy, being successful, by either contextualizing or contextualizing by owning that contextualization, building ecosystem platform themselves, or creating a platform that enables them to in-source into the banking solution other services that come from partners or fintech, which is basically telling the difference between the bank as a service that you use to insert your insights and data into different ecosystem, or the bank as a platform that is used to integrate the work of the fintech and other providers into your banking solution to enrich it. But the banking as a service, the bank as a service and the bank as a platform are just two sides of the same moon, right? Because technically speaking, they're always based on secure WAB cloud connections, interoperability, and transparent portability of all of your microservices, workloads. It's just the way you conceive it that make you feel they're not, but it's basically the same investment to do potentially two different things. Now, I've been working with clients that decided as bankers to compete in the platform economy by launching their platform solutions on one direction or the other direction. And if you like, the banking reinvention quadrant, the first time I used it in a more simplistic way compared to what you find in the book today is with a client in China, Shanghai Pudong Development Bank. They basically asked me after I made a presentation in one of their VM offices in China, how could they compete with Alibaba and Tencent? That was the question. That was the question from the board and the president of the bank. And the reason they put that question in front is because I used to discuss the difference between volume and value, saying that it's very difficult for banks to win on volume because e-commerce and big tech typically have many more touch points than bank can enjoy. But bank can differentiate on platform economies, seeing them slightly differently in their business to generate more value on, if you like, a bit more reduced volume. And that brought into the creation of this bank innovation quadrant concept that is the heart of a white paper that they published, and they're thanking us into the white paper, and we co-presented at the End Financial Conference in Shanghai, Fintech Inclusion Conference in September 2020. The paper is called Panoramic Banking, which is, if you like, exponential evolution of open banking into an ecosystem platform with an ecosystem perspective. And in that work, basically, we started discussing exactly this, why banks should not be scared about the bank as a service or the bank as a platform, and understand how they can monetize on the capabilities that they generate and create. The thing here, however, is that for doing that, you need a cultural transformation. And so that goes back to the question you put in front of us at the very beginning, is when the board and the CEO understand that the mechanics of the business model are different, they can engage into the transformation of the business model. Some might want to do it outright, others might decide to do it on the side, but one way or another, they have to do it. And there are examples of banks in Asia, in Europe, or in the US, which are engaging into this transformation. Last but not least, you see the changes at Goldman Sachs. So it's all interesting. So much is happening in the banking industry today. We need to systematize this journey with a map that makes sense, that helps, if you like, dividing and connecting the dots in the proper way. And that's the, if you like, intention of the banking innovation quadrant inside banks and fintech on platform economies.
Now, when bankers are listening to this, and I know we in our audience we have several listening, and they hear words like transformation, and we need to change, and we need to change the way we think, and we need to become a platform. They are taking a very deep breath and starting to think about how many millions of euros is this going to cost me in order to complete the IT transformation necessary to actually get this done. Now, I mean, from your perspective, what is the impact on banks' information systems, back office and front office, in order to get there?
Well, it's a very good question, actually. And in the banking innovation quadrant, when we'll engage in reading about that, there are two axes. One is information, one is communication. Maybe we have some time to explain. But the quadrant represents different value spaces. In the bottom left side of this quadrant, I put traditional and digital banking, okay? And in the upper right quadrant, I put the emerging platform strategies of contextual banking and conscious banking. Now, why digital banking is at the bottom left? Because Accenture estimated that between 2015 and 2018, $1 trillion was spent in digital transformation, but more chrysalises were generated than butterflies. They don't explain why. I'm here explaining you why this has basically happened. Now, in order to explain, I will go back to Mario Draghi. When Mario was the chairman of the European Central Bank still, and 2 weeks before leaving office, he was asked in the press room of the ECB a question by a journalist that was basically quoting the CEO of a very important bank in Europe. And the journalist said, don't you think that negative interest rates, so the exercising of the systemic put, will generate the next collapse of the financial system? And Mario Draghi said, basically, I invite you to Google and check that sentence. He said, well, I know that banks would love positive rates, right? Unquestionably, he goes, but he goes, in essence, rates will be negative and low for a long time. He says there are other things that they need to consider. For example, the cost-income ratio, especially for European banks, compared to other banks, which we know is one of the worst. And actually, that is reflected in the market capitalization of European banks. The price-to-book ratio of European banks is trading way below 1 on average, and is the lowest across international banks. But then Mario Draghi said, what I believe needs to happen is that banks have to adjust the business model to the digitalization of financial services. Now, it didn't say banks have to digitize their business model. The focus is on adjusting the business model, so changing it one way or another. And that is the point here. Many that applied the digital technology to the bank in the concept of the digital banking, they still created a very linear digital bank, like a distribution channel of products on digital. But there are reasons why that doesn't work. And those reasons are dependent on the fact that there is a misconception of the capability of clients to self-direct themselves on digital when it comes to financial products as opposed to products like e-commerce. So creating digital linear businesses can go up to a point. So to break out from this corner and basically reach new and higher business value spaces, banks need to understand how to abandon, bit at a time, the output economy and enter the outcome economy so that the business model can be remunerated. And I understand that this is not easy, right? Because there's different incentives that needs to be created and changed. So that's why you need to start from the top. This type of digital transformation doesn't start at the bottom. It's not a plug and play or new capabilities to make an existing business model more efficient. Now, you can still do that. Things don't happen overnight, but you need to start thinking how to do that very differently. And this is the essence of the advent of the platform economy.
I think you're making a very interesting point there, which is spot on. When you look sort of traditionally over the last, I would say 10 years or so, banks have been very focused on exactly like you said, digitization. They've taken existing processes, existing products, and they've just digitized them, moved them from analog to digital, and then put some certain amounts of fancy wrappering around that when they've looked at their digital bank. But what they really need to be focusing on is digital transformation, as you said repeatedly there, Paolo. There is a need now to do that transformation rather than just moving from analog to digital.
Yes, the reason is because you see my iPhone, which is mobile technology, that is digital technology. This is a technology of the demand. So you never said, Paolo, what goes on Amazon? You go there to buy one of my books and you already have an intention. And then maybe Jeff Bezos is smart enough to move you around. But typically you go there with a certain specific purpose. But most of the revenues that matter in banking today operate in an offer-driven economy. So the question is, how do you put an offer-driven economy on a demand-driven technology? If you don't resolve that problem, you will not be successful on digital in the end. Now, you can be misled a little bit here because when you look at the fintech ecosystem and the fintech innovation history for the last 10 years, you see some champions and some unicorns. Opening close bracket, the private market evaluation is not necessarily indication of a sustainable business model going forward. But this is the reason. The reason for that is that if you divide a banking group into the main business units or business areas, you have payments, credit, investing, and insurance. Now, payments, where you have the biggest unicorns, is very symmetrical. That means it's more demand-driven. If you get convenience in paying, you will engage into the mechanism. So you can create virality, you can scale up exponentially, right? And you can start grabbing a market. Still, the margins are very difficult to be enough for the remuneration of the cost for building that business, which you see with many of the neobanks and so forth. If you think about credit is also fairly symmetrical, so demand-driven, because you get the money to buy something, like to get a house or to finance your purchases, right? The problem is that most of the growth we saw in the fintech today is about unsecured loans. So you can get a lot of customers through onboarding, but if you don't have big shoulders to manage the credit risk, you have a sustainability problem, right? So you really need to have big shoulders to do that, which is the strategy of some very powerful and capitalized institutions that want to enter into that digital world, and they utilize the credit mechanism for onboarding, initial onboarding of clients, because it's easier for clients to onboard in knowing that mechanism, but they're not going to generate the real remuneration through that if they wanted to play the banking game. So they need to look for investment management or insurance, and that's where things change dramatically, because when suppose that I need to sell to you life insurance, to go to the extreme, I need to tell you that you're going to die. It's a difficult conversation to do with a chatbot, right? So that's why bankers in the end are still relevant, because building that communication element totally on digital is not easy. So you may get into an hybrid model where digital technology or artificial intelligence provide more contextualization to the banking conversation to make it cheaper and more effective going forward, right? Until maybe one day they could be totally digitized or not, right? So I don't own the future. But these are the real elements and things that need to be resolved. So that's why we need to look a bit further below the surface, deeper into the way effectively financial products are consumed, to understand how to rebuild on the platform economies with the remuneration on the outcome economy, a new relationship with clients that justify the fees, and that sets banking apart from their contenders. So yes, they can be more digital. Yes, they can build ecosystem platforms, but they can do better than their contenders in terms of creating new relationships with clients on the outcome economy. This way they will differentiate and they will remain a very important industry. The alternative, well, commoditization and becoming utility and disappearing. So is a choice in the hand of the bankers, is not a choice in the hand of their competitors.
Now, our conversation today has been very focused on banks for a reason. I mean, there's a lot of work to be done in the banking space to move into truly digital propositions, outcome-based platform economies. But at the same time, in my day-to-day work, when we work, for example, with APIs towards our customers, and then we present our fancy new premium API and we propose integration and automatic processes, then the first request that comes out of the customers, either treasury or IT, typically treasury or IT department, is that this API is great, it's JSON, everything is great, but could we have this response as CSV? In order for them to actually put it into an Excel sheet instead. So what would you say to bankers? I mean, can bankers become almost like ambassadors for digitalization in the broader ecosystem, or should we wait for the customers to be digital first? Or how do you see this dynamic playing out?
If you don't do it yourself, you can't expect your clients to do it with you. So I don't know if you know about the famous Bezos Memo. This former employee of Amazon then went working for Google, was writing on an internal blog of Google about the next platform that Google wanted to create. And he was very critical with Google to the point that he mentioned this memo of Bezos. And unfortunately, that comment went into the public space. So everybody started reading about that. Nobody knew about it before. And what Jeff Bezos was basically saying, and that's very interesting, so it seems to be real, right, not mythology, is that he would not discuss which is the technology that is applied inside the company to share data, to build repositories. But one thing is important, it needs to be based on APIs. So the data needs to be accessible by everybody, because it's no one's data, but it's the client data or the company data, right? So by enforcing that inside the organization, which is a cultural perspective and posture, then everything else it can be resolved, right? So it can work more easily. And now this is the problem that bankers have to face. Now, we released as the IBM Institute for Business Value, a very interesting research a few months ago, named Unlock the Business Value of Hybrid Cloud. They basically demonstrate statistically, if you like, or tries to explain statistically why combining cloud investments with enterprise transformation can multiply the impact of revenues by 20 times in banking, 13 times the average across industries, 4 times for automotive. It doesn't mean that there's more dollars, right, in the industry than in another one, but it means for banking that there's more pain, but there's more gain. And the demonstration, the analysis basically goes down into the real problem of the game, which is the following. If you have 100 euros on the table that you can gain with digital transformation, and you only do cloud, which is the foundational technology for everything to happen and to work, you can, yes, get some impact on revenues, but it can grab only 5% of the money on the table. But 95% of the money, think about a casino, will remain on the tapis there, right, on the table. Now, how do you grab the 95%? And 5 to 100 is basically this times 20. Well, you need to do 3 different things. You need to work with enhanced data and AI and automation, fair enough. You need to work with enablers like cybersecurity, which is very important in every industry. You need to shift security to the left to make sure that you don't reinvent the security wheel every time you create a new product, you move a service from one platform to another competitive platform, so on and so forth. But the third was revealed to be the most important, that basically corresponds to more than 40% of the money on the table. That is called the open organization. It's about culture, it's about platforms, it's about ecosystems. And why is that? We just said that at the beginning of this podcast. The bank is divided into different business units that are created around the products and the regulation of those products. But no client can only buy one product and fulfill their scope in life, being a financial scope or a non-financial scope that needs finance to facilitate basically that outcome. So now, by working on the platform economy means tearing down those barriers, so changing the culture of the institution and the way people work in order to see client centricity in a different way. Now, client centricity in the output economy means I now understand a bit more about the client and I start shooting the products, which has a limitation on digital because of the difficulty of clients to sell direct themselves, and therefore to be sensitive to this type of marketing because of regulation and so on and so forth. On the outcome economy, instead, the client centricity means that no single product can fulfill a client, and the relationship is what has to be paid for. And this you see clearly in all of the examples that move towards higher value spaces on the outcome economy on platforms. For example, you think about Amazon as an example that contextualizes banking anyway, because they have one click right by, so all those payments elements are contextualization examples. Now Amazon stabilizes the revenues of the marketplace through Amazon Prime. Punct. Okay, so that's the point. On the conscious banking side, instead, you see the emergence of planning, where banks create fee on top and they want to be paid for the relationship, right? So that's what they're attempting. UBS, for example, entering into the US by providing portfolio management for zero cost, hoping then to basically monetize on the relationship with the client for more advanced services. So this is the biggest cultural shift that banks needs to go through. If they can go through that and resolve the incentive mechanisms, they resolve this element called open organization, so they can grab 40% around the table. Now, if they do that, you understand that even data and AI becomes more powerful, because until you have different data repositories, you keep on building maybe customer views which are more enriched, but you cannot create an all-in pricing in front of the client. You go back into the product conundrum, which is basically experiencing an evaporation of the margins. So that cultural transformation is difficult. I see clients, banks or basically fintech that are basically starting the journey that are moving in that direction. The intention with my work and my literature is basically to help systematizing all of this, creating some more simpler language, but anchoring it to deep theory, again, because the shift is seismic. So we need a better theory to build a better industry.
So one of the things that the banks have been doing, all along, is forcing customers to consciously do banking, right? As you said, Paolo, very much around the products, making the customers take that decision. I'm going to make an appointment. I need to do something with my money. I need to engage with the bank. The customers these days are wanting to have unconscious banking. They don't want to have to think about the fact that they need to do banking. They don't want to have to make an appointment to see their banker. They just want their financial life to happen. But as you're also saying, there is a need to start building that relationship again, where the banks can actually take advantage of the client centricity and also the relationship with the client. Does that mean that we need to help banks to get back into a world where it becomes conscious again?
You need both. That's the point. If you look at insurance, which is the most asymmetrical business in financial services, because it doesn't really deal even with risk, but with uncertainty to the limit. And think about car insurance. Car insurance is compulsory, so it becomes very symmetrical. Everybody needs to have. But in markets like the UK, which are highly digitized, if I'm not mistaken, almost 50% of people still buy through a broker. Okay, so the risk of excluding people, okay, without giving them the possibility of making a decision through a relationship is there. So we need to work on that to make sure that there is a good balance in front of everybody. Some will enjoy the digital, others might not enjoy the digital. There has to be space for everybody. Banking, insurance are very important industries. The point, however, is that if you cannot contextualize everything, because not everything can be contextualized, and you still operate as a bank, and you need to be paid transparently and visibly for what you do for a client, because there's more transparency, regulation, and so on and so forth. If you do not increase the element of consciousness into the relationship in the scientific sense of the term, the clients will not see the value, so the clients will not reward you for that value. So that's a simple problem. Now, if you want, maybe as a way of concluding the podcast today, contextual and conscious banking are very connected one into the other, and is their connecting point to generate the highest value in the industry, because you need to be capable of building in front of the client a relationship engagement model that enables them to navigate through banking and non-banking solutions according to what they have to do to manage their life in the real world, if not in the metaverse. But then the starting point are different. It is the opportunity to eliminate frictions in an ecosystem that makes banking contextualized, that means embedded. But mind, when you eliminate the friction, you will not be remunerated for the friction elimination, because clients will assume it's a given. So you need to own the whole platform economics in order to monetize. Instead, it is the need to demonstrate value in front of the client that makes banking conscious, because the remuneration comes, as we said, shift out of products because of the margins that are going down into the relationship. So contextual banking unlocks new value because it allows you to organize or orchestrate an ecosystem that was not organized before. So it's value that was not there, and all of a sudden the value can appear because you use digital and use finance to eliminate the frictions into an ecosystem orchestration. Yeah. Conscious banking platform strategies instead enables you to unlock hidden value, because there's value inside banking, which is now hidden through layers, which is stratification of habits that corresponded to a world where you had much higher interest rates, much higher embedded commissions, right? Where you could basically afford it, where the client basically, let's say, was okay. Now we're in a completely different world. That's what Mario Draghi basically said, that the new normal that comes out of 25 years of exercising of the systemic put and so on and so forth. So in this new world, the demonstration of value becomes very important, but it doesn't happen outright. So you need to revise the business model and the foundations to create platforms that operates in a different way, which corresponds, by the way, to the shift of revenues of a bank today. You know that banks operate under core banking and interfaces. Core banking means payment and credit. If you look at most of the European banks, that doesn't generate the return on equity anymore, or not significantly. So that's why a lot of banks are shifting towards the interfaces, the communication, which is wealth management and insurance. But even there, if they enter that as a linear industry, so those margins will be under pressure continuously anyway, right? And the problem they're experiencing is that those margins might go down far faster than their capability to restructure a cost. That's why they really need to think from the board down about these strategies in the platform economy, one way or another. So they will have to be more contextualized and more conscious at once.
Yeah. Now, as we say on Fintech Daydreaming quite often, time really flies when you're having fun. And Paolo, I literally think we could be talking forever about these topics. Fantastic insights. I think our listeners really got a lot out of this almost 1 hour episode, I think, at this point in time. So unfortunately, we have to wrap up in order to let our listeners to do something else as insightful as all of this is. But
go and read Paolo's book. That's what they can do.
That they can do. And yes, in order for them to do that, Paolo, I mean, how can people find the book? How can they get in touch with you if they want to have more discussions on these topics, and maybe get some Christmas present ideas?
Well, they can do 3 things. They can basically reach out on LinkedIn in particular, where I keep on having more open and continuous conversations. They can go to Amazon, if not the Wiley web pages. So the book is on all Amazon marketplaces worldwide. And I also invited to check my other work on the ibm.com/IBV, where I also share the formal thought leadership, like the Unlock the Business Value of Hybrid Cloud IBV paper is truly revealing. So you've got the 3 ways of getting back. Please engage.
Great. And we at Fintech Daydreaming, Paul and I, only have one Christmas present request from you, dear listeners, and that is that please, there's a subscribe button right there. Just hit the subscribe button and you will get all the Fintech Daydreaming goodness this season and the next season when we will be back with our podcast. Yeah. Now, yes, Paul, do you want to say something?
No, I was just saying, yes, I was agreeing with you, Villa. 100%. Hit that subscribe button.
Fantastic. And also remember to check us out on YouTube. We really enjoy people maybe even watching us on YouTube, even though I have a bit bad lighting condition going on here at the moment, but I'm sure you will survive this little technical problem. But Paul and I will be back in 2 weeks' time with another episode, which will be actually
I'm not too sure about that. If you check your calendar, 2 weeks' time is Christmas Eve.
Oh, okay.
So maybe we'll have a slight earlier or later episode, but we will have one last episode of the season. But I'm not sure we're going to publish one on Christmas Eve.
We talked about contextual banking. This is contextual podcasting because
exactly.
You both say so. There we go. So yes, we will be back in 2 week-ish time with a special episode which will end this season of Fintech Daydreaming, and we will be back for season 5 after that episode. But before that, look forward to our special episode at the end of this season. Again, thank you, Paolo. Paul, good as always. Looking forward to being back with you in 2-ish weeks, and this has been Fintech Daydreaming.
This is Fintech Daydreaming.